Hey everyone. In this class, we're going to cover chapter 3 of your textbook. Let's do a review first. So in the previous class, we talked about there are 9 steps to the accounting cycle. Specifically, we started from analyze the business transaction. So a business transaction, it can be any event that happened to the firm. And by analyzing the business transaction, we basically analyze the effect of this transaction on the accounting equation. The accounting equation is assets equals to liability plus stockholders' equity. So the effect of any event on the firm's asset, on the firm's liability, and on the firm's stockholders' equity. And this is step 1, analyze the business transaction. And then after we have analyzed a firm's business transaction, we can move to the second step, which is generalizing. Generalizing is basically we're trying to express a business transaction in terms of debit and credit. So a journal entry, generalizing is making journal entries. And a journal entry usually have, we're going to debit some kind of account for some kind of amount. And then we credit some other account for some other amount, but in total, the amount we debit should always be equal to the total amount that we credit. So this is step 2. And step 3 is posting. In the posting step, so when we are making the journal entry, it's going to involve several accounts. And posting is, we're going to post the amount to the respective account. So for example, if the journal entry is to debit cash 100 and credit revenue 100, and this journal entry is going to touch upon 2 accounts, cash account and revenue account. So in the posting stage, we're going to post it to so we debit cash 100, so we're going to post it to the debit side, which is the left-hand side of the cash account for 100. And we're going to post it to the revenue account, specifically the credit side of the revenue account for 100. So this is posting. And trial balance is basically, so at the end of the financial reporting period, all of the accounts is going to cumulative a lot of transactions. For example, for cash, we may have one of the transaction may involve debit cash for 100. And then a second transaction may involve payout. The firm may pay out cash, $50. So we need to credit cash, $50. And then a third transaction, we're going to debit. If the firm received cash, 200, we're going to debit cash, 200. So at the end of the financial reporting period, we're going to calculate what is the net balance. So first of all, is the net balance at the debit side or at the credit side? And second of all, what is the net amount? And in this situation, the net amount is 250 at the debit side. So for the trial balance, we're going to list all of the accounts the firm has. And then we're going to list the balances for each account. For example, for cash, the balance is 250 at the debit side. So those are the first steps we talked about in previous class. And in today's class, we're going to talk about adjusting entries, adjusted trial balance, and financial statement. So basically step 5, step 6, and step 7. So this is basically a brief review, and we already talked about it. So posting, we post it to respective accounts. And trial balance, this is an example of a trial balance. We have a list of different accounts, and also as well as the balance for each account. The balance can either be at the debit side or at the credit side. Okay, so So the first thing we're going to talk about in this class is going to be the adjusting entry, which is step 5. And with regard to adjusting entry, the first question you may have is, so what is adjusting entry and why do we need adjusting entries? Adjusting entries, those are basically one kind of journal entry. So adjusting entry is the same as all of the other journal entries. We are going to have debit and we are going to have credit. We're going to debit some kind of account, for example, account receivable, and we're going to credit some other account, for example, credit revenue for 100. This is one kind of adjusting entry. It is going to look the same as all of the other journal entries, debit and credit, some account, some amount. The difference between adjusting entry and the journal entries we talked about previously is adjusting entries, they are usually not initiated by any transaction during the period. So it's something like we need to make at the end of the financial reporting period before we make financial statements. If we do not make adjusting entry at that time, our financial statement is not going to be complete. So we need to remember that we need to make those adjusting entries in order to make our financial statement complete. This may sound a little bit abstract now, but I'm going to explain about it right away. Hopefully it will make it clearer to you why we need adjusting entries and what those adjusting entries are. So basically, why do we need adjusting entries? We need those adjusting entries because of 2 reasons. First of all, because the current accounting system we use, we have a time period assumption. And then second of all, our current accounting system, it is accrual-based accounting. So what is this time period assumption? If you think about how firms operate continuously. So for example, a firm may be established maybe 50 years ago and it continues operating for 50 years. And so one way to do accounting is we can just wait until like from the start of the firm until a firm dissolves at the end. So either went bankruptcy or dissolved by itself. So from the start to finish, we can wait for all of those 50 years to make a financial statement. So this is one way we can do accounting. And if we wait all of these 50 years until the end of its operation to prepare its financial statement, then actually we don't need adjusting entries. So no adjusting entries are needed. However, can we really wait 50 years to make a financial statement? The answer is no, because most of the firms, they need some kind of periodic feedback about how well the firm performed before this firm ends. So that's why for accounting purpose, we usually divide the economic life of the business into artificial time periods. And these artificial time periods can be either in terms of months, in terms of quarter, or in terms of year. So those are totally arbitrary time periods that's divided by accountants. And usually if it is monthly or quarterly time periods, that is called interim period. And if our accounting time period is 1 year, that is usually called a fiscal year. So, and the fact that accountants divide the life of the business into artificial time periods, this is called time period assumption. So, so you may ask, so what? How does it relate to adjusting entries? So because accountants divide the economic life of the firm into arbitrary time periods, many business, they are going to inevitably so many of the business transactions that happen during the life during the whole economic life of the firm, they are going to be inevitably affect more than one accounting time period. It's just because those accounting time periods, those are divided arbitrarily. So business transaction happen continuously. They don't care about the accounting period. So some of the business transaction inevitably they're going to affect more than one accounting time period. And an example of this is, for example, Citigroup purchased a new building, and for Citigroup, purchase a new building is just a normal business transaction. However, for accounting purpose, so does it make sense for Citigroup to expense all of the cost of the building at the time that the purchase was made? So that is a question for accountant. And then the answer is it doesn't make sense. The reason is this building that Citigroup purchased, it's going to benefit the firm for a lot of years. It's going to benefit the firm for more than 1 year. So it doesn't make sense for Citigroup to expense the full cost of the building just in the year that it is purchased. So this is an example of a business transaction, the purchase of a building affect more than one accounting time period, in the sense that it affects more than 1 year. And then the question here is, so if something like this happen, in which period should we record this transaction? So that is the question for accountant. And specifically, we're interested in when should we record revenue and when should we record expense? The reason those are two very important questions is because the difference between revenue and expense, that is the firm's net income. And that is usually how we measure a firm's performance. So in which period should we record a transaction? We actually have two choices. There are two possible periods. We can either record a transaction in the period in which the event occurred, and this is called accrual-based accounting. And we can also record a transaction in the period in which cash receipt and payment occur, and this is called cash-based accounting. And according to the current US GAAP, generally accepted accounting principle, we need to use accrual-based accounting. So cash-based accounting is more, so the tax accounting is more cash-based, but the current financial accounting, which we're talking about in this course, financial accounting is usually accrual-based. So, and then the US GAAP is also requires the use of accrual-based accounting. And more specifically, under the US GAAP, when should we record revenue? The rule here is companies record revenue in the accounting period in which the performance obligation is satisfied. And so what is performance obligation? Performance obligation is basically a promise, an obligation to perform something. So when a company agrees to either perform a service or sell a product to a customer, it has a performance obligation. And when the company meets those performance obligations by either performing a service or providing goods, it can recognize revenue. And this is the rule under the current US GAAP. And similarly, under the US GAAP, when should we record the expense? And the rule here is companies recognize expense in the period in which they make efforts to generate those revenue. And this is also called matching principle. We're trying to match the expense to the revenue that those expense generate. So here's an example. Please take 5 minutes, try to work on this example on your own, and you can pause your video for now. So in this example, ABC Bakery sold a cupcake worth $5 on February 14th, and you paid ABC Bakery the $5 on February 15th. So the question here is, when should ABC Bakery recognize revenue associated with this transaction? And the answer is, so if you use accrual-based accounting, the answer should be they can recognize revenue on February 14th, because this is when ABC Bakery delivered this cupcake to you. So according to accrual-based accounting, this is when this event happened. However, if you use cash-based accounting, it should be February 15th, because this is when you receive ABC Bakery receive cash. And let's look at another one. So please take some time, work on this example on your own, and you can pause your video for now. So in this example, ABC Bakery pay its employee $3,000 per month. And Tom, who's an employee, working in the month of January. However, ABC Bakery paid Tom his January salary on February 17th. So the question is, when should ABC Bakery recognize expense associated with this transaction? So according to accrual-based accounting, it's actually ABC Bakery should recognize it on January 31st. And the reason is because Tom performed service for ABC Bakery in January, and the service Tom performed helped ABC Bakery to generate revenue for the month of January. So the associated expense, the salary and wage expense from Tom working for ABC Bakery in the month of January should be recognized in the month of January. However, according to cash-based accounting, those should be recognized at the time when ABC Bakery pay Tom his January salary, which is actually in February 17th. So this is the difference between accrual-based and cash-based accounting. And under US GAAP, you should keep in mind that we use accrual-based accounting, which means that in the previous situation, the revenue should be recognized at the time when the firm delivered the goods or provide the service. And in the second example, the expense should be recognized in the same time period when the associated revenue is recognized. So we have talked about what is the time period assumption, and we have also talked about what is accrual-based accounting. And then you may wonder, then how does it relate to adjusting entries? So adjusting entries, as we mentioned previously, it is also one kind of journal entries. And we need adjusting entries every time a firm prepares its financial statement. And the purpose is to ensure that accrual-based accounting is followed and the financial statement contains the complete information. So let me give you some examples of adjusting entries. And I'm also going to explain why we have those entries as a result of accrual-based accounting. So the first example is wage expense. Employees help firm generate revenue. And then, however, in order to be efficient, so every day an employee come to work for the firm actually incur wage expense. However, that wage expense, it is not recorded every day just because it's not efficient to do so. So what the firm usually does is at the end of the month, wage expense are recorded by the firm through an adjusting entry to ensure that the expense is recorded in the same time period that revenue is earned. And this is because that we have that, according to accrual-based accounting, the expense should be recognized in the same time period that revenue is recognized. So it doesn't matter whether the wage is paid out next month. The wage expense should always be recognized when the associated revenue is recognized. So it has nothing to do with when wages are paid out. Another example, depreciation expense. So some of the expense they incur not because of transaction during the current period, but because of transaction during the previous period. And one of the example is the purchase of those fixed asset. Another way we call fixed asset is we also call it long-term asset. Those are one kind of long-term asset. So for example, if a firm purchased a machine in the year 2019, and that machine can help the firm generate revenue for the next 5 years. So according to the US GAAP, the depreciation expense needs to be recorded by the firm through some adjusting entries at the end of each of the 5 years that when this machine is helping the firm generate revenue. In order to ensure that expenses are recognized in the same time period that revenue is earned. So we're not going to, even though the firm purchased the machine and maybe the firm paid out the whole cost of the machine in the year 2019, we're not going to recognize all of the cash paid. So for example, if the machine is $1,000, we are not going to recognize all of this $1,000 in the year 2019. It's just because the machine is going to serve the firm for 5 years. So it doesn't make sense to recognize the whole cost in just 1 year. And what we need to do is, if the machine is serving the firm from 2019 to 2023, we are going to allocate this $1,000 over the 5 years when the machine is serving the firm and recognize it through depreciation expense gradually throughout these 5 years. And this is also because that we have that matching principle for expense recognition under accrual-based accounting. And then another example is utility expense. So for example, a firm may use some utility, some electricity and water for a month. However, it's not going to receive the utility bill until maybe next month. So, and because this utility helped the firm generate revenue for the current month. So at the end of the month, utility expense needs to be recorded by the firm through an adjusting entry in order to ensure that the expense is recorded in the same time period that revenue is earned. And it has nothing to do with when that utility expense is paid out by cash. So those are some examples of adjusting entries and why we need to make those adjusting entries as a result of the accrual-based accounting. So when we talk about adjusting entries, there are actually two types of adjusting entries. One is called deferrals. The other is called accruals. And the difference between those two types of adjusting entries, we have an economic event happening here. And if the cash flow happens before the economic event, that is called deferrals. And if the cash flow happens after the economic event, that is called accruals. So specifically for deferrals, we have two types of deferrals. One is prepaid expense, which is also called prepayment. The other is called unearned revenue. And the difference between those two is for prepaid expense, usually that's a cash outflow. So those are expense paid in cash before they're actually used or consumed, or before we say that we pay out those expenses in cash before those expenses actually happen. And then for unearned revenue, that's a cash inflow. And those are cash received before goods are delivered or services are performed. So those are two types of deferrals. And with regard to accruals, we have accrued revenue and accrued expense. Accrued revenue is usually a cash inflow. So those are usually revenue. We perform the service or deliver the good first. The economic event happened first, but the cash flow happened later. So we receive cash later. And accrued expense, those are cash outflows. Expense usually happen first, and then we pay out cash later. So let's look at each of those different types of adjusting entries in more detail. First of all, prepaid expense. Prepaid expense, as we just talked about, those are usually expense, those are prepaid. So we pay out cash first. So cash outflow happens first. And then expense, the accrual-based expense happen later. So when expenses are prepaid, so when we pay out cash for those expenses which hasn't happened, we usually debit or increase an asset account in order to show that because we paid out that cash, so now the firm has the right to receive that service, or the firm has the right to receive those goods in future. And examples of prepaid expense, we have prepaid insurance. So firms paid out some insurance in cash first, paid out maybe 1 year's insurance. And then the firm now has the right to receive those insurance service in the next 1 year. Supplies, the firm paid out cash and bought those supplies, but the firm hasn't really used those supplies yet. Prepaid rent, the firm may pay out 1 year of rent expense upfront, and then, however, the service or the firm is using that building throughout the year. So, and also PP&E, so which include, for examples of a PP&E is property, plant, and equipment. So examples are buildings and equipment. They can be viewed as a prepayment as well. Even though usually like we tend to separate PP&E with the other. So for example, for prepaid insurance, supplies, prepaid rent, usually those are short-term current assets. And PP&E, it is a long-term asset. However, in the essence of PP&E is pretty similar to those other types of prepaid expense. So let's look at some examples here. Please read this example and you can pause your video for now. So in this example, this firm purchased supplies cost $2,500 on October 5th. And the firm did an inventory count at the end of business on October 31st. And then the firm found out that only 1,000 of the supplies are still on hand. So this means that the firm has used up 1,500 supplies. So this is the supplies that is used. And the question is, what is the journal entry on October 5th when the firm purchased those supplies? And what is the adjusting entry on October 31st at the end of the month? So the journal entry on October 5th when the firm purchased the supplies, firm spent cash $2,500 and supply increased $2,500. At the end of the month, the firm find out that it has used 1,500 supplies. So that is an expense for the firm. We debit supplies expense for 1,500 and we credit supplies for 1,500. And this journal entry, this is an example of our adjusting entry. The next example, please take 5 minutes, read this example and try to write the journal entry on your own. You can pause your video for now. So in this example, the firm paid $600 for a 1-year fire insurance policy on October 1st. The coverage began on October 1st. And what is the journal entry on October 1st? And what is the adjusting entry on October 31st? So on October the 1st, when the firm paid this 1-year fire insurance policy upfront, the firm paid out cash. So cash decreased by 600. And then on October the 1st, the firm hasn't used any of those insurance yet. So the firm does not, so it is not the time that the firm can recognize any expense because the firm hasn't used this insurance policy yet. So that's why we put it as an asset for the firm. Prepaid insurance, that is one kind of asset. So this represents the firm's right to enjoy that fire insurance policy in the next 1 year. We debit prepaid insurance for 600 and credit cash 600. And then at the end of the month, now the firm has used this fire insurance policy for 1 month. And 600 divided by 12, that is $50 per month. So at the end of the first month, we can recognize insurance expense for $50 because the firm has used this policy for 1 month, so that we can recognize $50 for the 1 month insurance expense. And then accordingly, we decrease prepaid insurance for $50 because now we no longer has the right for this $50. $50 insurance. So yeah, this is an example about prepaid insurance. And the next example, please take 5 minutes, try to write out the journal entries on your own, and you can pause your video for now. So in this example, the firm purchased equipment costing $1,200. The equipment is estimated to benefit the firm for 60 months using straight line depreciation and assuming 0 residual value. So we're going to talk about it later in the course when we talk about PP&E. But here it's just I'm just going to tell you the depreciation expense directly. So actually the equipment cost $1,200, and the way we calculate depreciation expense is a way to allocate this $1,200 over the 60 months, and straight line is one method of allocating that expense. So the initial cost is $1,200, and then there's no residual value. We allocate it over 60 months. So each month, the depreciation expense, the allocation is $20. So this is how you get those $20. But at this stage, you don't need to worry about how we get this $20. The question for you is, given that each month the depreciation expense is $20, what is the journal entry on October 1st? And what is the adjusting entry on October 30th? So on October 1st, the firm spent cash $1,200 to purchase equipment $1,200. And then there's no expense that needs to be recognized on October the 1st because the firm hasn't begun using the equipment yet. However, at the end of the month, the firm has already used this equipment for 1 month. Now the firm should recognize depreciation expense. Specifically, so this journal entry is wrong. We debit depreciation expense for $20 and we credit accumulated depreciation for $20. And accumulated depreciation, this is a contra account. It is a contra asset account. Specifically, it is contra account to equipment account. Yeah, it's a contra account to equipment. And on the financial statement, the amount you are going to see on the financial statement, it is going to be the net amount of the equipment account and its contra account, which is accumulative depreciation. So the net book value of equipment that is reported on the balance sheet, that is going to be $1,180 on October 31st. So those are about prepaid expense. And then next, we are going to talk about earned revenue. So when firm receive cash, so earned revenue, that is cash flow happen first, and then the accrual-based revenue can be recognized. So when firm receive cash before goods are delivered, when can we recognize revenue? That is when either goods are delivered or services are performed. So when firm receive cash before that, they usually need to record a liability, and that liability is called unearned revenue. Because firm cannot record revenue yet, firm hasn't performed service or delivered the good yet, they cannot record revenue at this point. And that is a liability for the firm, because now the firm has an obligation to perform the service or deliver the good in the future. And here's an example. Please take some time, work on this example, and you can pause your video for now. So in this example, the firm received $1,200 in October 1st for advertising service expected to be completed on December 31st. And analysis shows that the firm performed 400 of those services in October. What is the general entry on October 1st, and what is the adjusting entry on October 31st? So first of all, on October the 1st, the firm received cash. Cash increased by $1,200. And at this time, the firm hasn't performed service yet. So the firm cannot recognize it as a revenue for the firm. However, the firm does receive cash. So this created a liability for the firm in the sense that now the firm has an obligation to perform that service in the future. So we credit unearned service revenue, which is a liability for $1,200. This is what happens on October the 1st. And then after 1 month, on October the 31st, now the firm has already performed 400 of those services. So the firm can record revenue at this time, credit service revenue 400, and debit unearned service revenue, because now the firm no longer have this obligation for 400. The firm still have the rest of the 800 obligation as its liability. So that is unearned revenue. And then the next kind of adjusting entry is called accrued revenue. Accrued revenue is when the revenue happen before the cash is received. So when companies have delivered the good or performed the service, that is when the revenue can be recognized. But the firm has not yet received cash. And in this situation, they can record an asset that shows the cash that the company will receive in the future. And examples of accrued revenue, we have account receivable, that is an example of accrued revenue. Interest receivable, rent receivable. So all of those receivables, those are examples of accrued revenue. Here's an example. Please take 5 minutes. Try to work on those journal entries on your own first. and you can pause your video for now. So the firm performed service was in October, the firm performed service was $200. And on November 10th, so service is already performed. And this is when the firm can recognize revenue. However, the cash is not received until November 10th. So what is the adjusting entry at the end of October? And what is the journal entry on November 10th? At the end of October, October 31st, the firm has performed the service was $200. So the firm can recognize service revenue in the month of October. However, because the firm hasn't received the cash yet, it creates a receivable for the firm. Now the firm has the right to receive this $200 in the future. So that is the journal entry on October 31st. And then on November 10th, the firm received the cash. So, and then we credit account receivable because the firm no longer has the right to receive this $200 again. Again, the firm has already received it. So it's no longer an asset, an account receivable for the firm. And then the last kind of adjusting entry, those are called accrued expense. So this is basically expense happen before cash are paid. When company has incurred expense but not yet paid in cash, and in this situation, they're going to record a liability to show that cash the firm is going to pay in the future. And examples are just different kinds of payables. We have account payable, interest payable, rent payable, salary, and wage payable. And here is an example. Please take five minutes, try to read this example and write out the journal entries on your own. And you can pause your video for now. So in this example, the firm signed a 3-month note payable in the amount of $5,000 on October the 1st. The note requires the firm pay interest at an annual rate of 12%. So an annual rate of 12%, if we divide it by 12, 1% is the monthly rate. The note and the interest will both be paid at maturity. What is the adjusting entry on October 31st and November 30th? And what is the journal entry on October the 1st and December 31st? So let's look at all of the journal entries here. On October the 1st, this is when the firm signed the 3-month note payable. The firm signed a note payable to someone else. And this is usually a way that the firm gets some short-term financing. The firm issue a note indicating that the firm is going to pay some money to the lender in 3 months. And in return, the firm is able to get some cash immediately. So we debit cash because the firm gets 5,000 cash on October the 1st. And this is a payable for the firm because the firm by signing this note, the firm make a promise to pay this 5,000 in 3 months. So, and then at the end of the first month, the interest, because the firm has used this 5,000 for 1 month now. So even though those interests are not going to be paid at the end of the 3 months, but still because the firm has been using this money, so the firm needs to recognize interest expense, which is 5,000 multiplied by the interest rate for each month. And this is $50. And then because the firm hasn't paid it yet, so we credit interest payable for $50, which indicates that now the firm has a liability. The firm has an obligation to pay this $50 in 3 months. So that is on October the 31st. And then next month, the firm has used this 5,000 again for 1 month. So at the end of November, the firm needs to make the same journal entry again. On December 31st, this is when the firm has, first of all, used this $5,000 for another month. So we're going to make the same journal entry again. But at the same time, the firm is going to pay both of the principal and the interest of this note on December 31st. So the firm is going to pay cash $5,150, which includes the principal $5,000 and the interest payable, which is $150. So those are all of the journal entries involved in this transaction. Let's look at another example. So you can pause your video for now and try to write out the journal entries. In this example, the firm pay monthly salary of $1,200. The October salary is not paid until November 15th. So what is the adjusting entry on October 31st, and what is the journal entry on November 15th? On October 31st, even though the firm hasn't paid any salary yet, but because the employees has worked for the firm for the whole month of October, so the firm needs to recognize salary and wage expense in the month of October, which is $1,200. And because the firm hasn't paid it yet, so that becomes a payable for the firm, which is called salary and wage payable. And then this indicates that the firm now has an obligation to pay this $1,200 in the future. And then on November 15th, when the firm pay out those salary and wage in cash decrease, and the firm no longer have this liability. So those are examples of adjusting entries. And now we have finished talking about adjusting entries. The next step in the accounting cycle is called adjusted trial balance. So which is basically after the firm has has made all of those adjusting entry and has posted all of those adjusting entries, the balances for each account is going to be different. And then the firm needs to prepare an updated trial balance, taking all of the account as well as the updated balances. And this trial balance, it is called adjusted trial balance. So adjusted trial balance, that is the primary basis for the firm to prepare its financial statement. Most of the numbers on the firm's financial statements, those are taken directly from the firm's trial balance. So, and then after we have made the those are taken from the firm's adjusted trial balance. So after we have made the adjusted trial balance, we can go ahead and prepare the firm's financial statement. And here are some examples. So for example, this is the firm's adjusted trial balance. We have all of the accounts as well as their balances. And then for the firm's income statement, basically we take all of the firm's income statement account and arrange them according to a certain format into a statement called income statement. Statement of retained earning. So actually in real world, it is the statement of shareholders' equity, and it is much more complicated than what is shown here. Balance sheet. So we take all of the balance sheet account and arrange them according to a certain format into a statement, which is called balance sheet. And we are going to talk more about those statements in detail in future classes. But now, the thing you need to know is, so basically how we make financial statement. We take each account from the firm's adjusted trial balance and arrange them into different kinds of statements. So yeah, this is all for today's class.